So, Leanne, we were talking about the 4 programs that are available. Let's talk about the differences in those programs.
Okay, so the 4 programs we talked about, the SBA EIDL loan, let's start with that one. This one is specific to coronavirus. It's a new program. It is a 3.75% interest rate loan paid out over 30 years, and it is for working capital. You can pay expenses, accounts payable, other bills. You can pay your required debt payments that you would normally pay during that same time period if the disaster had not occurred. It is not intended to replace lost income or to refinance long-term debt. Your payments are deferred until the 12th month, and interest accrues during that whole time. The interesting thing about this one is that there is a $10,000 advance that will be forgiven that is made available to businesses, and you can get that theoretically very quickly. I haven't heard of anybody getting theirs, but that's what we're hearing. The Paycheck Protection Loan is for a business to get a 0.5% loan, 0.5% interest loan from a bank, pays it off. You have to pay it off in 2 years. The payments start back after 6 months. And you can apply for 250% of your average monthly payroll from 2019. That's 2.5 times whatever you paid a month in payroll. The idea is that you use 75% of that. You must use 75% of that to pay payroll. Your payroll can't decrease. The number of employees you have can't decrease since what you had on March the 25th. Whoever you had, however many employees you had March 25th, and whatever you were paying them, it's got to stay that same amount. They give you a 10% margin error. If you go down, then your forgiveness amount will be decreased by that. And you cannot use more than 25% of that loan for non-payroll, or it will affect your forgiveness amount. So that is a loan that you get from your bank. If they're an SBA lender, banks are starting to accept application over the next couple of days. And then if you get that, it may be forgiven if you're in compliance. The SBA debt relief is not a loan. It's not an advance. It is simply, if you have existing SBA loans other than the SBA Economic Injury Disaster Loan, not the PPPL, other pre-existing SBA loans, the SBA will pay your payments, principal and interest, for 6 months. Now, the key to remember is that if you are having that automatically deducted, your payments automatically coming through, you've got to stop those so that you're not paying those while the SBA is also paying them. And then the SBA Express Bridge Loan is an existing loan. It's been there. We've had it for other disasters. So the banks are familiar with it. They already have the guidance and the applications. If they're an SBA lender, they've done them before. This is so you can get an express loan to bridge you from the time you need money until you get that larger SBA Economic Injury Disaster Loan. And it is a higher interest rate. It's prime plus 6.5%. But you can then turn around as soon as you get that lower interest rate economic injury loan, and you can pay this one off in full. This is simply to bridge those businesses that need cash now until they can get their larger SBA EIDL loan, because you can get those from the bank and they have a faster turnaround.
So at the bottom of this video, there'll be a link that you can get more information.